This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachurdes. Thanks for joining us at xm.com. A stormy quarter for global markets is drawing to a close. Hopes for a soft economic landing have all but vanished as the Fed continues to beat the drums of forceful rate increases, sending financial markets into a tailspin. With bonds getting blasted alongside stocks and even commodities rolling over lately, there has been nowhere for investors to hide. Stock markets took another beating yesterday at the hands of some solid U.S. economic indicators and more resolute Fed rhetoric. The number of Americans seeking unemployment benefits keeps grinding lower week after week, signaling that the labor market remains incredibly tight despite the Fed's best attempts to cool demand. The S&P 500 lost around 2% as fears of over-tightening by the Fed and quarter-end flows joined forces in the absence of any real corporate buying, since most companies are now in their buyback blackout window. Generals such as Apple and Tesla, that were carrying the market on their shoulders for months, suffered the most damage, leaving a leadership vacuum that is often a harbinger of more weakness. In the FX complex, the dollar took a step back this week, but it is still about to close the quarter with tremendous gains. The reserve currency has been on a roll this entire year, capitalizing on a perfect storm of interest rate differentials widening in its favor as the Fed outguns other central banks, safe haven flows, and an absence of any attractive alternatives. On the opposite side of the coin is the euro, which managed to claw its way higher this week after getting bulldozed the entire quarter. Nerves surrounding the British pound seem to have calmed for now, with the currency staging a fierce comeback from the record lows it brushed earlier this week. The Bank of England seems to have restored order, although nothing has really changed overall. Sterling is still at the mercy of global risk sentiment thanks to the nation's swelling twin deficits. As for today, geopolitics will be back on the radar. Russia's president will attend a signing ceremony at 1200 GMT to annex 4 more areas of Ukraine following some referendums in those regions. Markets have stopped paying much attention to this conflict, yet the recent advances by Ukraine and the military call-up by Russia suggest the war is likely to drag on and even escalate. Finally, the Fed's second-in-command will deliver some remarks at 1300 GMT. Brainard doesn't speak often, so traders will pay attention. This is today's Daily Market Comment. Thanks for joining us at xm.com.